Hi, and welcome to this week's edition of Macro Minutes. I'm your Head of Trading, Mark Gardner. The information summarised in this webinar does not constitute financial or professional advice. It is general in nature. It doesn't take into account your specific circumstances and should not be acted upon without a full understanding of your current situation and future goals. Rightio, stocks in our universe this week. We've got Raise Invest, Worleys and Magellan Financial Group. We'll start off with Raise. In monthly data released for September, Raise reported a significant deceleration in FUM, only increased 0.29 in September versus 6.92 in month-on-month in August. Although Raise management attributed some of it to weaker markets as well as ongoing impact of COVID, they provided very limited supporting commentary on the weaker markets. Raise is still very well positioned to reach two milestones for Indonesia, Malaysia by calendar year 2020, 200,000 and 100,000 active customers respectively. Thailand beta version is expected to be operational in the first quarter of next year, however hinted at potential earlier delivery. They closed down at 176 yesterday. They've actually rallied today. They're up around, I think it traded a high of 195. We released a recommendation which got executed at 170 on those. I think it might have been the stock of the week 2 weeks ago in the trading portion of the webinar. So you would have been in there and probably roughly about 10% of the money already on those. So very good company, this one. Very good product, and they seem to have gotten through their recent board upset, where the founder and CEO basically took a more powerful role. I've actually met with both of them personally. The plans for the business are very good, and we're actually looking at doing a corporate webinar with those guys later next month. Next up, we've got Worleys. Woodside awarded them an extension to a non-binding frame agreement for brownfields engineering, procurement, construction management services at Karratha Gas Plant and Pluto LNG assets in WA. They've provided brownfield engineering services to Woodside for 30 years under a variety of contracting models. The current management agreement has a further option to extend. Service will be executed by Worley's Perth office with support from the Global Integrated Delivery team in India. They closed up 1.7%. They've had a bit of a rough time of it lately. They got down to about 9.20. They're trading around about $10.50 or something at the moment. Just before they reported, they were up around the $11 mark. It's quite a volatile and illogical stock at times, Worleys. They seem to get awarded contracts and then fall for some particular reason. But obviously with the energy crisis going on at the moment, oil and gas prices skyrocketing, they are tied a little bit to those prices. So seem to be enjoying a little bit of tailwinds for a change for the moment here now as well. So. And speaking of a company that has the opposite, no tailwinds at the moment, Magellan. Their September results saw a total FUM outflow of nearly 4%, partially explained by client portfolio rebalancing and Magellan's new ETF, the High Conviction Trust. Over the last quarter, their total net outflows have amounted to $1.5 billion or 1.3% of the average FUM in the quarter, with net retail institutional outflows split being 40-60 or 617 and 910 million respectively. Institutional outflows were due to three key clients rebalancing portfolios, namely global equities for 410 million, infrastructure equities for the same, and Australian equities for 180 million. However, all three were attained at mandates more than 2 billion in cash each. Approximately 23% of new retail outflows were due to redemptions from the Magellan High Conviction Trust, with the total FUM standing at 889 million as of the 30th of the 9th. They closed down 4% at $32.52 on the day. I think they've recovered to about $33.50 today. Look, this has fallen fairly dramatically from highs of $54 probably about 3 months ago. Obviously, their funds haven't been performing very well, and they really are running the risk at the moment of losing quality staff, because these guys get paid on bonuses for outperforming the index, and the funds haven't been outperforming the index. So, salaries generally aren't enough for these guys. Yeah, look, they should probably stabilise. They're a bit of a value fund overall. They had an extraordinary run and have been in cash, probably way too much cash, obviously, for how much they've underperformed the index in the last 6 months. Obviously, the last month may actually help, given it's been a little bit down, 5 to 7% across the board in global equities. So that may have actually helped them against the index. But I guess we'll see in the next month's numbers. Rightio, now we've got the trading stock of the week. This is one of the ones that was part of the monthly feature play for the trading department. So the last 3 monthly feature plays have been progressively leading up to this sort of shaky sort of September, October area. We went defensive 3 months ago. We went correction last month, and then we've gone buy the dip this month. So this is part of the buy the dip. So what WiMAX is basically, it's you're owning the top 20 Australian stocks on the ASX, and you're selling covered. What the fund does is it sells covered calls against them, which is essentially an insurance policy. It will underperform in situations like last year, where the market continually rallied quite hard, because obviously they would have, when they're selling the calls, they would have to actually get back into the positions. It's great for a market that generally is going to go sideways, because they're going to take some extra insurance premium. So in a market where, say, the index, for instance, ranges between 6,800 and 7,800 for the entire financial year this year, they'll do very well in distributions. As you can see there on the chart, the blue dot and about 5 bars back was their distribution, which is about 24 cents, which was 4% for the quarter. That gives you an example of, obviously, July through September was a fairly sideways to down month. That distribution doubled from 12 cents in the previous, where obviously the market had rallied quite well. So it's going to protect your downside, and in range-bound markets, it's going to give you a little bit of extra premium. Obviously, you'll have the big 4 banks, the big miners and things like that in it as well. So obviously those top 20 stocks. So they're all very solid companies. It's a pretty appropriate strategy to have on at the moment. Say, for instance, we pull back to around about the 6,700 mark. You would probably look at, buying gear, which is a leverage long. But realistically, at the moment, with it being, with volatility being quite low in the scheme of things, WiMAX is a really good option. So the entry around 770 would have happened after the distribution. Obviously, the entry price would have been higher at 790 otherwise. With your target price there, I dare say you probably, because this thing is high yielding, you would want to be taking into account your distributions there. So if we continue to see 25-cent distributions, and this is a quarterly distribution, then you probably would be, minusing at least half of that distribution off where your target price is. So, look, it would be the sort of thing that it will get to 870 when the index gets back to record highs. So, the general expectation after such an incredible rally last financial year, which is one of the best in history, you would expect the market probably to not go that hard again, particularly with rising interest rates coming in the next year or so. So look, it's a pretty good conservative strategy with great distributions in great companies. So that's one you could probably do quite a decent chunk of size in, and it's fairly low risk. Rightio, stocks to watch out for. We've got Bank of Queensland, Harvey Norman, and Rio Tinto. Bank of Queensland, obviously Australian bank, which provides retail banking, business banking, leasing, finance, insurance. They had strong results in the first half of 21, statutory profit up 66% to 154 million, reflecting their digital transformation initiatives. They experienced momentum in line with home loan growth. This year, they acquired Members Equity Bank, or ME Bank. It's a digital cloud-based business which specialises in offering mortgages. That was the industry super funds, I think, set that up. Their financial year 21 results will reflect 2 months of revenue contributions from ME Bank, and is likely to be the primary focus in evaluating the results. It does give them a good expansion into New South Wales and Victoria as well, and South Australia. Home loan growth continuing over the second half of the financial year. Their main business second half results are expected to reflect this phenomenon. Although APRA has clamped down and increased the interest rate buffer from 2.5% to 3%, so we're probably going to see a bit of a contraction. Housing prices have risen the fastest rate in 30 years, and we all know what happened 30 years ago, the late 80s, early 90s. So look, it's, we would expect that home loan growth is going to be a little bit capped. So this one's not a bad one, obviously, but given that it's going through a bit of expansion. I'd definitely be reevaluating your other big four banks if you've got them, just in case. I think it was I think NAB may have been our favoured one there, and Westpac our least favoured. But yeah, look, be mindful that obviously these big banks are really very mortgage based. So we'll see what the home loans figures are like over the next quarter as these APRA regulations come in. APRA did say that it wouldn't really affect things too much, and most banks usually have a higher buffer than that anyway. But look, I don't think these increases in housing prices is just sustainable in the long run, with their biggest concern being the ratio of average annual income to house price now is stretched well beyond 6 to 1. And that's the highest in the world. The IMF's made a comment on the Australian housing market as being overextended as well, although they have been wrong about that probably 6 out of the last 6 times. It does seem to keep going up, but look, it just goes to show you in the scheme of things globally where how expensive our housing prices are. Next up, we've got Harvey Norman. They've announced a fully franked dividend of 35 cents a share. They're going ex-dividend on the 15th, so that'll be next Friday. Payable on the 15th of November. Current prices, it's a yield of 7%, which, look, and I've had a look at this, but it's a potential trading recommendation as well. It's a great thing to have in your portfolio. They've fallen away about probably 15% over the last couple of months, but coming into Christmas time, as we start to get our vaccination rates up as a country, New South Wales obviously triggering the 70% vaccination rate yesterday. They do have quite an expansive geographical footprint, and they're almost like a bit of a REIT in a way. They own a lot of 3.2 billion or something, I think, in property. They've got global expansion as well into Eastern Europe, but they reported a 63% increase in net profit to 750 million after repaying the JobKeeper subsidies worth 6 million. EBITDA rose 54% to 1.4 billion. Total revenue of 9.7 billion, which increased 1.3 billion from financial year 2020. Home-focused expenditure, as well as strong growth in technology and digital connect homes, driven by remote working and learning, were the main drivers of sales growth. They expect to open 3 franchise complexes in Australia and 3 company-operated stores overseas. Furthermore, offshore expansion plans to ramp up towards the end of calendar year 22, with 8 company-operated stores to be open in financial year 23. Obviously, as we come into, people will start spending more money on travel and things like that rather than their homes as we come out of lockdown. That is a bit of a risk for this thing, but overall, very solid business, which is expanding. It's actually at a fairly reasonable price, and that's, it's a fantastic yield at 7%. Obviously, the cash rate's at 0.1, so I think it's a fairly decent value around here at the moment. Next up, we've got Rio. 16th of July, they had their Q2 production update. They guided for calendar year iron ore shipments to be in the range of 325 to 340 megatons. Since the first half, iron ore shipments were at 154 megatons, which is 46% of the midpoint of the guidance. Rio needs to significantly catch up in the second half to meet its guidance at a time where its shipment rates have been more volatile than its peers. Thus, an uplift in shipments is expected in the September quarter, despite the seasonal maintenance heavy quarter. Rio's portfolio has a larger exposure to iron ore, which has impacted Rio's near-term earnings outlook given the recent iron ore correction. September quarter prices declining 20% compared to the average US $200 a tonne in the June quarter. I think it's more around the $110 a tonne average mark. This, in the scheme of things, really though, no one expected iron ore to stay up around the $200 mark. It's fallen. These mining stocks have been absolutely beaten up. They're still great quality companies with low debt. They're at historical PE and dividend yield highs, basically. PE lows and dividend highs. They're very much out of favour at the moment because of the uncertainty in China with Evergrande, and obviously the reduction in the the lead up to the Beijing Winter Olympics. China's really working on trying to improve their air quality. There's been rolling blackouts and things over there as well. I think once we get through this uncertainty in China, these companies represent extraordinary value where they are in the long term. But look, just at the moment, they just can't seem to win a trick really. So I think I heard a stat that I think for someone like BHP or Fortescue still makes 15% with iron ore at $65 a tonne. So it's still 15% margin, that is profit margin. So they're still making a lot of money. Like as I said, they don't have a lot of debt either. So their portfolio really, the seasonal increase in shipments from both Australia and Brazil at the end of year, steel production cuts in China are expected to see the iron ore price decline slightly further. It has fallen nearly 50% now. Personally, it seems to have stabilised and rallied out of its lows for now. It's probably rallied about 20% out of its lows. So look, sideways would be a great result for that thing for the next 3 months. And as we reopen, all these infrastructure spending projects and things from governments globally are still going to be around. So look, everyone still needs steel, and still they can work out a way to produce steel without iron ore. They just need to work out a way to do it a little bit cleaner is the only problem there. So, and obviously the cost of thermal coal going up as well is not probably helping the steel production. So just as another aside, the ATO has issued further assessments on the dispute first issued earlier this year regarding interest deductions for year 2015 by levying penalties worth $350 million and reducing the interest amount from $47 million to $27 million. So look, they've still got some stuff going on with the ATO there, but these things tend to pass overall. Rightio, looking ahead, we've got US CPI, FOMC minutes, Aussie unemployment rate. We've also got FOMC tonight. It's not FOMC, apologies, US non-farm payrolls tonight. That's probably the key figure. We're expecting 500,000. Anything around that number is going to pretty much guarantee that they're going to announce tapering at the next FOMC meeting. We will basically, that'll come out at 11:30 tonight. Obviously, it'll be the US figures will be 11:30 until they move off daylight savings time, and then they'll move to 12:30. But yeah, the market is expecting a strong number over there. A really strong number is probably going to be, probably going to really cement that in reducing that timeline for tapering, and then obviously therefore interest rates going up. That's going to probably affect, the tech end of the market more than anything else. It'll be slightly helpful for financials. So, your small cap tech stuff with high PEs is going to be really hurt by, any increase in interest rates overall. So, if you've got anything like that within your portfolio, that's, it's worth reviewing. We've also got US CPI for September. It's your overall inflation number. The core number takes out energy. Obviously, energy's been quite high with the hurricanes and then the energy crisis going on in Europe for natural gas, etc. Oil inventories did rise a little bit in the US. The US were going to release some of those inventories, but decided against it. Oil's at 3-year highs, so and things like travel and used car prices and hotels have really contributed to CPI. I think the payrolls number is going to be far more of a weighting to markets than CPI generally. and we'll probably see, there'll be some PPI numbers come out as well, I would imagine later, Thursday or Friday. And we've also got FOMC next Thursday at 5 a.m. Detailed record of the most recent meeting will largely be ignored because I think the November meeting is the real meeting where they're going to hand down any decision on timelines for tapering. There's been a lot of Fed speakers over the last month, so most of this stuff's going to be out there. That people might be looking for any notes about the two recent FOMC members that resigned in very quick fashion due to their trading activity, but overall, I would say that they'd probably steer away from addressing that and probably stick to the usual thing that and they've had a press conference after that meeting as well. So I dare say there's not going to be a huge amount in that. We'll probably be looking for the meeting later in the month. Next Thursday, we've got our Aussie unemployment rate as well. Still going to be COVID affected. It seems to be largely ignored. We've been getting fairly impressive employment numbers in Australia, considering half the country's been locked down. It doesn't seem to be on the RBA's radar massively. And look, we'll basically, I think, be paying far more attention to the numbers next month and the month after. Obviously, New South Wales coming out of lockdown as of Monday. So I think forward numbers are going to be more important there because it's going to be, given the sample size, it's going to be a little bit difficult to trust the number on that one. So look, overall, October generally is seen as as a down month or a risky month. If you go back through the statistics over the last sort of 70 odd years, October's more of a volatile month rather than a down month. The latter half of September is really where and early part of October is really where the market comes down. But on average, we generally rise about 0.3% for US S&P. So expect a fair bit of volatility. We've got Evergrande. China's been on holidays this week. We've got Evergrande announcements probably next week as well as they come back out. And we'll probably see some more movement in iron ore prices as well because that market's been largely shut. So we'll get some more news out of China next week as well. So Asian equities may be a bit of a risk, but realistically, pick out what you. My advice would be pick out what stocks you like. Find some entry prices. You don't necessarily have to be going to market. Find some entry prices and levels that you like in those high quality companies, and let the volatility work for you, as opposed to be scared by it. Being well planned in these periods where the market's quite up and down is by far the best way for you to get the best result for your portfolio overall. So it's one of those periods where you need to make sure of your research. Keep having a look at yourself up to date with the trading department before the bell, and email or the logging into the Maqro research portal, because these sorts of periods are where that stuff you'll really get the value out of your subscription overall. But so thanks for attending, and we'll talk again next week.